very quickly, we are a payment automation platform for MSPs. Baxter probably won't like how much I simplify this, but you know how you can sign in and pay your electric and gas bills? Well, we give MSPs a payment portal just like that so your clients can log in, view past and current invoices, update payment information, set up autopay, and more. We've also got some incredible insights to help you, the MSP, understand your cash flow and other important metrics. Donza, would you like to take a couple minutes and tell people what Clear Peak Capital is doing?
Yeah, perfect. And I'll kick it off with the presentation actually, if that works.
Sure,
Can everyone see my screen?
we can.
Perfect. So yeah, quick introduction on Clear Peak Capital and who we are. My background is I've spent 10 years in private equity. Most recently at a fund in New York, we had about $1.5 billion under capital, and recently launched my own firm, an independent sponsor, along with my co-founder Luke, in January of last year. And so we'll talk a little bit more about what an independent sponsor is. Fundamentally, we invest within the IT services landscape. We got 4 folks at our firm, and then multiple operating executives. Some of you may have heard of Service Leadership. Brown O'Connell's partnered with us on our MSP strategy and looking to invest in that space. We have one portfolio company looking to do 2 more acquisitions in 2025. To talk more about that later. But fundamentally, the purpose of this presentation is to, one, articulate a little bit of why are people excited about MSPs? Why are investors excited about this landscape? From there, what does the buyer universe look like? And then lastly, within that buyer universe, what matters? What questions should you as a potential seller be asking, or I believe you should be asking? And then lastly, how does that manifest itself structurally? And so starting with just the investment thesis in the MSP landscape, investors fundamentally, they're looking for kind of future free cash flows and then that predictability around it. And so when you've got an MSP with this contracted revenue base, it's growing over time, and there is that pathway, that's what gets people excited. And so the investors fundamentally, they want that visibility. They want to see those contracts and understand that, all right, if you're doing 10 million in revenue this year, we can guarantee that 9 million at least is going to come next year, and we can build off of that base. Another aspect is the fact that it's a very fragmented landscape, and there's the opportunity for a buy and build. And so colloquially, a lot of people talk about 1 + 1 = 3, or some form and fashion of that. What it really means is that the sum of the parts, when you take one MSP and take another MSP, bringing those together is fundamentally more valuable than individually. And that manifests itself through kind of 3 avenues. One avenue is just you now have a more diverse base of clients. And so previously, if you have one MSP and they have 50% of the revenue in one client, you combine it with another one, that concentration goes down, and it's a less risky investment, so to speak. The other aspect is synergies. And so when someone buys your company, they're looking at both bottom line, so cost cutting, and that's what you hear about with private equity all the time, but also revenue synergies. And I think that's what's more exciting and really more realistic within the landscape. What you'll see is in the MSP world, say you buy an MSP that's providing just managed devices, IT help desk to 100 clients. The exciting aspect from an investor's base is if you can buy that MSP and you have a security offering, or you have an Azure offering and everyone's on-prem, but you can convert them to the cloud. You then take that existing customer base and you sell further services and products into it. And so, go ahead, Steve.
No, I was just gonna say. So it sounds like, I'm gonna name names. So when Kaseya gobbles up another MSP platform, right? Their main goal is to start cross-selling that to their existing customers. It almost sounds like what you're saying is, a lot of times MSPs will find ways to cross-sell their different services to their existing customers, simplifying it, right?
That's the goal. Generating more cash flow from those 2 entities combined versus individually is the goal. And you can accomplish that through selling more services through it. There's the entire aspect of you only need one CEO, you only need one CFO, that type of thing as well. And so it's fundamentally, how do you increase the cash flow of these two entities when you bring them together? That's the main goal of it. And that's what allows for kind of the buy and build process to work. It is generating kind of more cash flow by bringing them together. Additionally, there's obviously less risk associated with those if you just bring them together. So if you did nothing else, if you brought 10 companies together and you brought them all under one roof, nothing changed, that's a more valuable entity because there's less concentration of cash flows within that bigger organization. But does that broadly make sense, Steve?
It does. It absolutely does.
Cool. And so that's why there is so much investor appetite within the MSP landscape, is that you can bring a lot of these together and you can create a lot of value by having this bigger organization and this bigger entity, coupled with just the inherent nature of the MSP revenue model, which is contracted, predictable, and you look at kind of the outsourcing trends as well as just the fundamental growth drivers within the IT industry. All of that creates an attractive asset class, so to speak. It is what has garnered interest amongst a pretty big universe of buyers. That universe of buyers, we've effectively kind of categorized it across these 5 lanes. You have strategics. Strategic is really characterized by they have an existing MSP. You could broaden that really to they have an existing asset within IT services or they want to get into the MSP space. But really, it's they don't have an institutional backing is how we look at it. You've got private equity-backed strategics. Private equity-backed strategics just means that they have a private equity firm that has funded them, and maybe just pausing a bit on what is private equity. Private equity is fundamentally it's a pool of capital that a general partners invest to generate a return. That pool of capital is coming from pensions funds, family offices, high net worth individuals. They're giving that money to investors to then buy companies, and hopefully they buy those companies and then they sell them for more than they bought them for. And that's what generates a return. And so as a part of that entire process, generating that return is what matters. And how they do that is what's really the difference between private equity funds. And so, go ahead, Steve.
Sorry, I always thought of private equity as high net worth individuals. I never even thought about, pensions and other pools of cash.
Yeah, so it's primarily endowments, pension funds, big insurance agencies. And so high net worth individuals and family offices is probably is a minority of the capital that's allocated to the space. You've got Texas teachers, New York State teachers, fire departments, police departments, all of that on a state basis. Those have pension funds, they allocate that. You've got universities, they're allocating that to the asset class of private equity. And that's a bolt of the assets, really. And so they're, think of those across 2 lenses. One is it a private equity backed strategic? And so that just means that a strategic company or a company within the MSP space is owned by a private equity fund and they're looking to do add-on acquisitions. The other is a private equity kind of platform investment. That means the private equity firm is going directly to you, the MSP, and saying, we want to build out an MSP investment and most likely do an M&A strategy around it. Another category broadly are independent sponsors and searchers. So independent sponsors, very similar to private equity, but they raise on a deal-by-deal basis. So private equity, you have a committed fund, they raise $200 million. They then have the discretion within that fund to buy assets as the GP decides. But then an independent sponsor, you're finding a deal within your investment thesis, and we're an independent sponsor. You find a deal within your investment thesis, and then you raise capital from a network of individuals, a network of capital providers on a deal-by-deal basis. Lastly is searchers. searchers are probably best characterized by they're coming into the company and they're looking to do a full buyout of that company and ultimately run and manage it. So those are effectively the 5 categories. I think it's important to dissect them a bit more and really understand. I think to really understand them, you have to understand what is their source of capital and how are they thinking about a transaction. And so within just kind of taking them as well, strategics, if they don't have an institutional backing like the private equity fund, they're typically funding your transaction with a mix of debt and or cash on hand. And that provides different dynamics. What I mean by that is who's really making the decisions. Is if they have to go and raise debt for this deal, then the bank and getting the bank involved, that's going to be kind of a key decision maker. Within private equity backed strategics, there's equity coming from the fund. The important part there is to understand what fund has invested in the MSP. And so you have this private equity kind of monolith of like, all right, this is private equity XYZ firm. Within that firm, there's fund 1, there's fund 2, there's fund 3, there's fund 5, what have you. If the MSP investment is in fund 3, what you want to understand is how much money do they have actually to allocate to new deals. And so you look at how long had that investment been in the portfolio, how old is it? All of those are factors that you should be thinking about and considering because that determines kind of their legitimacy and their ability to kind of pay. When you're dealing with a private equity-backed strategic, you're typically talking to the VP of business development. You're talking to the C-suite. Sometimes the PE professionals will get involved, but a lot of times it's concentrated at the portfolio company. Fundamentally, though, what's interesting is in a private equity-backed strategic, really the partner and really the managing partner of the firm is the one signing off on the deal. Even if you've never met them, fundamentally, they're the ones signing the check. In that regard.
Donza, I'm super familiar with on the PE-backed strategics. I mean, there are obviously a ton of them. Intiva, Ameriplex, Evergreen. What's an example of like strategics in this space who are, and maybe there are strategics that I'm familiar with that I just don't have current private equity backing?
Yeah, so I think of strategics probably on the smaller side. And so I'm not thinking of a firm that has 500 million in revenue and or a multi-billion-dollar public, which is pretty similar. I'm thinking more of your buddy's been in the MSP industry for 20 years, has done 5 acquisitions. Each of them are 200, 300,000 in revenue. And so it's more of a kind of the MSP landscape's pretty interesting in that regard, and that you have M&A has always been a component within it. And previously, before private equity, it was the more entrepreneurial folk who were leveraging their balance sheet, taking on debt, taking on cash on hand, or individual investors.
Yeah, there's a great guy who I know named Sean Torres who runs a company called Intellicom based in the Southeast. And so he's started his MSP from square one, grown it, and acquired, I think, 2 other MSPs. So I guess that's the strategic camp, assuming that he maintains ownership and is just utilizing a bank to obviously fund that transaction. Makes sense.
Exactly. Yeah, I think that's a perfect example of what I'm thinking about within the MSP realm. Every industry is obviously very different. Then there's the bucket of private equity. In private equity they're coming in looking at it as a platform investment. And so that's a very different lens than if it's a private equity backed strategic. What I mean by that is they're looking to back the management team, they're looking to back the bones of the company effectively and grow from there. In almost every MSP deal, M&A is a pretty core component to the growth thesis. And so they're looking to do fairly high velocity M&A to hit their return thresholds. They're funding that from the latest fund. And so when I go back to, you look at a private equity firm, they have multiple funds. The latest fund raised is what's ultimately making this investment. And as the MSP seller, you'll typically be, depending on the size, you'll be interfacing with the associate, the VP, the principal, the partner at the private equity firm. But fundamentally, the managing partner or the founder is the one that makes the decisions within that organization. And so you've got various private equity funds, and every private equity fund's run a little bit differently. But the better ones, so to speak, they enable the partners, they enable the principals and such to be the voice of the managing partner. And so you may never even talk to the managing partner or the person that's actually signing the checks, but you still get to the same spot. Within independent sponsors, again, that's effectively who we are. We're a little bit different than private equity a lot of times, and what our pitch is, as opposed to within private equity, you're really reporting into a board of directors. There's monthly ops calls, there's quarterly board meetings and stuff like that. Our model is to be an augmentation of the management team. And so we're augmenting the team. We see ourselves within the company, as opposed to having the CEO and the founder report to us. It's how do we facilitate and help them make better decisions and take things off their plate. And so it's a little bit of a different model, a little bit more concentrated in that regard. And going back to that point, within a private equity firm, a managing partner could be on the board of 15 companies. With an independent sponsor, you're looking at 3, 4, 5 max. But it is on a deal-by-deal basis. And so when you're evaluating an independent sponsor, you want to understand, have they done a deal before? Do they have access to capital? Who are they talking to? Do they have connections within the family office space? Do they have connections within the SBIC space to be able to fund those deals? So that's an important aspect of it all. Lastly, searchers. Again, the characteristic there, they are definitionally taking over as the CEO or taking over explicitly within the management team. They typically use SBA debt. They'll have a personal guarantee on that debt, and they're taking out a majority of the equity. And so the reason why I want to spend time a little bit on the structure of these entities is because ultimately it impacts what they can do. And what I mean by that is we really think about it as an owner of an MSP, how do you think about post-close control? How do you think about the upfront cash that you're getting within a transaction? How do you think about the second bite opportunity? The second bite opportunity is really just it's a colloquial term for you have rollover equity, that you still have equity in your company, and it could be worth more on the subsequent sale. And then there's also certainty to close. Before I get into that, Steve, any questions, comments on the buyer landscape for this?
I have some questions. Feel free to tell me to wait if it's something you're going to cover later. So my first question is, can we go back to that last slide? When looking at these different buyer personas, are they looking? How do I phrase this correctly? Are they looking for something different, each of them? Like, for example, some of these might be looking to build like a platform where, like something like the 20, right? And then some of them may just be interested in acquiring a couple strategic locations to expand their reach, while others are trying to, dominate the world. So I'd love to understand like how each of these might think strategically, not to be confused with strategics. And then also, I would love to understand, and this is probably a more nuanced question, what each of these may mean for the current company culture, team, assets, etc.
So for that last question, I'll defer that to the next slide. But your first question on kind of what are they looking for? It goes back to really understanding kind of the source of capital. And what I mean by that is, if you have a private equity firm that's looking to deploy 50 million or 100 million into a specific deal, and those are the types of questions you should ask as an MSP seller. If they're looking to deploy that amount of capital into a specific MSP company, then they either have to start very big as a platform, or they have to do a lot of M&A. And so the people that are doing a lot of acquisitions, and I don't know the scale of them exactly, but they're looking to deploy a certain amount of money within the strategy. And so that's what's making them do 10, 20, 30, 40 different deals. A strategic, as we've defined here, they're probably going to be a little bit more thoughtful, slower, and it goes back to kind of, are they building out a couple services here, and being lower velocity. It's probably similar to independent sponsors and searchers as well. Again, everything funnels from kind of that source of capital and your access to capital. And private equity, they're allocating a chunk of it, and that's what's going to dictate the velocity. And so going back to our private equity-backed strategic, if the private equity firm has been in the company for 5 years or 8 years, the pace with which they do M&A was going to slow down most likely as it gets to years 7, 8, 9, and 10. Or they've already sold a subsequent time. And so what happens is, again, if you remember, private equity, they're ultimately looking to generate returns within these deals. So they buy a company, they then do a bunch of M&A, they get that 1 + 1 = 3, hopefully, and then they sell it to another potentially private equity firm, goes public or what have you. And so hopefully that helps clarify it. Again, I'm trying to provide like concepts that allow you to it's not as cut and dry as how do you ask the question if you're approached by one of these parties of what is their strategy, and what's dictating really that strategy.
Yeah, and I think that, Donza, you hit the nail on the head with that last point, which is there are obviously broad overarching concepts of where strategics spend their time and what they're looking for relative to private equity-backed strategics, relative to private equity firms that are looking for a platform. But I think the note for MSPs that's super important is just understanding what is their goal as part of the transaction. Where do their incentives lie? What are they trying to create? Do they just care about a return, in 3 to 5 years? Do they plan on holding the company for 10 years? All of these questions, I think in the landscape today, based on a lot of M&A webinars in the MSP space that I've listened to, everybody's calling it reverse diligence and making sure that you're doing diligence on your buyer while they're also obviously doing diligence on your business.
Yeah, I think that's exactly well said. And there's a lot of different ways to make money within this space. And I don't profess to think that there's only one way. And so you can make money by having 20 disaggregated MSP satellite offices that still maintain their entire brand. And you can make money by having a fully integrated 20 deals that are now operating under one brand, one complete back office, one complete centralized ticketing system as well. I think we personally have a preference on what we think works, but fundamentally you can make money a variety of different ways. It's, do you align with the culture? Do you align with what the private equity-backed strategic, private equity firms, strategic, any of these buyers are ultimately saying to you? And then it gets back to peeling back the onion of what are their incentives? And that's a function a lot of times of the capital, the duration of that capital, the cost of that capital as well. Going back to what dictates what matters to you in this concept of reverse diligence. There's really two reasons that, from my point of view, why reverse diligence matters. Is that you care about your legacy, you care about the culture of the company, and you want that maintained in some form or fashion. And so that requires you to have to do reverse diligence. Just as importantly is, if you believe in your company, you believe in what you've built, and bringing on a partner is additive, then you want to understand what that next second bite, so to speak, is potentially worth. And so when I think about if I'm in your seat, and I'm looking at this MSP buyer landscape, I'm really the first thing I'm doing is asking these questions. Do I want post-close control? Do I really care about the culture? Or most people are generally good. It's not going to be that bad, so I don't care that much. Do I want to have equity in this go forward ownership? And if I had access to money and more resources, we can accelerate this thing 3, 5, 10 times. Do I want to take a risk on certainty to close? That type of thing. There's trade-offs along the way. So I don't know if I need to go through kind of each one of these, Steve, but happy to dive into any one of them. Tried to kind of lay out a landscape here of generally what occurs. And again, if you truly understand kind of the landscape here, these become a bit self-evident. And I'll take like the second bite opportunity. If you're a platform investment and you're the first deal by that private equity firm, then your upside is going to be greater most likely than if you're coming in on year 6, you're one of 20 acquisitions, and they're saying you need to roll 30 to 40%. The value of that 30 to 40% rollover when they do a subsequent sale is most likely going to be less than if you were the kind of the platform investment or partner with an independent sponsor, so to speak. Again, everything is very much a generality. Everything needs to be looked at in specificity to really make an informed decision. But I think this general kind of landscape is probably generally right.
I think the other piece, right, is, and I think a lot of people do this, which is, they weight these different items for them specifically. So a certainty to close and going through the diligence process mean, is it 50% of your calculus? Is the second bite opportunity 25% of your calculus? Is the upfront cash 20% of your calculus? There's also, team, or Steve mentioned this, which kind of fits into the post-close control, which is kind of culture and team, right? And how much do you want to ensure that the employees who've worked for you for the last 5, 10, 20 years feel good about the decision? Obviously that's something that I feel strongly about, but, I don't run an MSP, and everybody's, decision may be different, and it's a personal decision, obviously.
Yep. No, I think well said. And there's that. It's not a zero sum here. You could sell to a strategic and lose a ton of control, but completely jive with their culture. You're like, wow, we're going to be in good hands. You could sell to a private equity firm, be in control, think that you're fully aligned on the culture, and 2 years from now, everything gets upended. And so it's all about, you need to build a relationship with the party on the other side of the table. And you need to understand their incentive structure, why they're doing what they're doing. It kind of balances those two out. And then ultimately what matters to you all. This is a little bit number heavy and complicated, but really when you ask these questions, you're what's important to you. This is your universe of buyers that ultimately can deliver. But then how does that manifest itself structurally? Like, what does that really mean? And so if you care about the second bite opportunity, what that means is you want more rollover equity, or you're okay with an earnout or a seller note. That just means you now have consideration in this go forward entity. And so, recommendation is you do get a good investment banker, you get a good lawyer to work through all these things. But I think once you have an idea of what's important to you, what's the universe of buyers, then it's all right. How do I structure a deal to accomplish those goals? The easiest one is everyone gets some type of cash consideration. Well, everyone. There's cash consideration, and then from there, I'll say there's this other tranche of the second bite opportunity. Second bite opportunity is a mix of rollover equity in the new entity. You've got earnouts, contingent payments, basically, if you achieve certain goals. And then a seller note is basically a fixed income instrument as well. A deal, quite frankly, can be structured in as many ways as you can come up with. And it's a little bit just about the creativity and solving everyone's objectives. As an investor, I'm looking to minimize my risk and maximize my return. And to do that, a lot of times there's alignment as a seller. If you're telling me that you can double EBITDA in 1 year, then how do I incentivize you to do that? And so it's a push pull between the buyer and seller, as well.
And I think this is where like a lot of the complexity comes into play. And the other thing is everybody, I think, outside in thinks about these deals as a multiple, right? Like, all right, how much are MSPs trading for in the market? I think generally people say, if it's a platform, it's over 10, maybe 13, 15 times plus potentially, depending on the size and scale and industry verticalization. How much does a single smaller MSP trade for? Generally, I think people are saying 6 to 8. But when you unpack some of those numbers, the devil's in the details as to how much cash is the owner taking off the table at close, right? Is there an earnout structure in that deal? So if they double the business, does the owner make more money, or is there no earnout structure? Is the owner taking a certain number of the company value and rolling it in equity into the new entity to take the form of that kind of second bite of the opportunity? Or some owners are just taking basically, a seller note is basically an IOU for future yield on the seller note, right? And so some deals could be structured as 100% of a seller note, but the company just got bought for 12 times EBITDA. If you look at the 12 times EBITDA, it sounds like, the owner just made out like a bandit. But if you're now getting paid as a seller note and there's uncertainty to making all those seller note payments over the next 5 years, let's say, it's obviously not the exact outcome that maybe the owner had wanted. And this happens a lot in all different industries when, a software company announces an acquisition or an MSP announces an acquisition. I think the face value is always obscured by the underlying details that are not public information.
Yeah, it's even as simple as if you have, so say this is an example seller, and they've got 10 million of rollover. If you believe because of the team you're partnering with is really going to be able to effectuate change within your company, then that rollover equity could be worth significantly more than just kind of that headline price. And so thinking about it, the day one close, everyone's happy, everyone wants to see a large number hit their bank account. But if a lot of private equity firms and independent sponsors and folks in that realm, they want to partner with the team as is. And so, and you as the team, do you jive culturally? Do you jive intellectually and believe that they can really drive value? That's just as or more important than a headline price. So I'm a seller and I have a bid for 55 million, but this other group, and both of them are asking you to roll over 30%, then you have to make a decision. Is that 30% going to be worth significantly more under this group? And I'll take 5 million less today to get 20 million more in 4 to 5 years. Just all part of the calculus, so to speak.
I have probably a dumb question. This is not the first time you've said it, Baxter. You've said it before where you've said the calculus, and I always assume you mean calculation and you're misspeaking.
Yeah,
I know you both were talking about the calculus, and I'm very confused.
No, I never took calculus in college because I couldn't get through pre-calculus. So I just
say it
sound smarter.
Yeah, finance people trying to sound smarter than they are. It's really to me basic arithmetic. If we're doing anything more than multiplication, we're probably doing something wrong.
That's hilarious.
It's a good call out. I like that. Shouldn't use it. It's the same as 1 + 1 = 3. I don't like that saying, but it's industry wide.
Do you have any other questions that you think would be helpful for the group?
So I'll be honest. When I look at this, so cash to seller, that makes sense. Rollover makes sense. What I'm a little confused on is I'm looking at that second column. Earnout, is that's something that gets paid to the former owner years down the line if things are going well, correct?
Yes, with well being a very generalized term and meaning anything. So you can put in an agreement that well is defined as XYZ employee stays with the company, or XY EBITDA is $10 million, or revenue is $100 million. And so it's any parameter you want. It's basically saying that in the future, the company has delivered X, whatever X is, and you get $5 million.
And then seller notes, that one I really don't get.
It's just it's an IOU. So it's basically it's a loan effectively. You're loaning the company. And so the company now owes the seller $5 million. And they're going to pay out 8% a year to that.
Gotcha.
I think it's a good point though, Steve. And I was going to use calculus, but I'll say math from now on. The sources and uses is kind of a private equity kind of technical term in a way, but all it's saying is where is the money coming from and where is the money going?
Yeah.
The money going is really what the current MSP owner should be thinking about, which is how much cash is going to hit my bank account on day one, which is the $30 million in this example. How much of the ownership stake in my business is going to be rolled over into the new entity, and hopefully I'm making an investment in the new company. And then based on some sort of milestone, it could be EBITDA, it could be revenue, it could be me staying with the company, I have a future potential payout of $5 million. And then there's this debt instrument, which is the IOU, of another $5 million, which also could pay out a cash yield on, right? So it could pay an interest rate on the 5 million of like 10%, but it would also again be paid at a future year, future month. And then the fees and the expenses are obviously legal fees, banker fees, broker fees, diligence fees, the list kind of goes on. And so, this is one of the key things I think that everybody needs to consider on the MSP side is when you look at, okay, my MSP is doing $5 million. I'm selling it for 10 times EBITDA. So it's a $50 million acquisition. But on day one, I'm only receiving $30 million of cash. And then, there are these other question marks as to, do I believe in the buyer? Do I believe in the game plan? Do I believe in the future strategy of this business? And some of those numbers you may want to discount, or you may actually believe that if I make a $10 million investment in the new company, that may be worth $20 million or $30 million or, even $60 million. I mean, some of these MSP, private equity backed strategics, I know really, really focus on their track record in making MSP owners much more wealthy based off of the rollover equity as opposed to the actual cash at close.
Yep. I think very well said. I agree with everything.
And the rollover equity, I mean, let's be honest, that's a great incentive across the board, whether it's to incentivize the seller to stay on board, or just to, because I guess the way I look at it is, if I'm going to stay on board, I still want to have some skin in the game. So that rollover equity is phenomenal. But if I'm just looking to sell my MSP and go retire on a beach and sip mojitos somewhere, maybe the rollover equity isn't something that I care about.
Well,
I think even in that Yeah, as I say, even in that scenario, you could still care about it, because if you believe in the business you've built, you believe in the partners that you have, you go sit on the beach, sip your Mai Tais. That's going to achieve a greater return than just putting that 10 million in the stock market, right? If you now just came into 30 million in cash, you got this 10 million that can be in the company that you helped build, or you can put it in the SP 500. A lot of times, you want the former. And as an investor, if you don't want the former and you're like, no, I'd rather put in the SP 500, it raises questions from our point of view. It's like, well, are we missing something? It could be a totally rational reason why you want that 10 million out of it. But it's certainly, from an investor's point of view, it gives us more confidence that you're aligned, you're incentivized, and you have skin in the game to make this successful. Even if you're on the beach, it still means that everything you represented as to what the company is, you feel good enough that between our vision and what you've already built, it's going to be a better return.
Yeah, and there's a lot of complexity in each one of these items. The challenge, there are pros and cons, and you could probably do at least an hour session on each one. One of the things that I find really interesting that's happened recently in the market with a big name is Evergreen, right? So Evergreen has done very, very well. They've acquired a lot of MSPs. They do utilize rollover equity for a lot of those businesses that they've acquired. But instead of selling Evergreen, as the fund has expired at Alpine Investors, which is the private equity fund that backs Evergreen, they created a continuation vehicle, which allows them to hold on to the company for even longer. So I'm sure a lot of MSP owners who rolled over equity in 2018 or 2019 or 2020, thought that they'd get their investment back, which I think I'm sure it's made money in 2023 or 2024, but now they're probably going to be waiting, another 5 years until they actually monetize and liquidate that rollover equity. So, timing is also another really important concept of, when are you going to actually be able to monetize the future potential, uses or cash flows here.
That makes perfect sense. A lot to digest. Donza, I'm sorry, go ahead.
Now, I was going to say, I agree. There's a lot of nuance behind each of these, and it is a lot to digest. But enjoyed the conversation.
Yeah. So, can we talk about company culture for a minute? Typically, when an MSP is acquired, like by strategics or even private equity backed strategic, it's being acquired by typically an MSP, right? So that seems easy enough for two MSPs to kind of come together and figure out how to bridge their culture together. But when you start looking at companies like yours, independent sponsors and searchers, how does that really affect company culture? Because aren't you looking for larger MSPs to acquire at that point, or are you looking at a bunch of small to medium MSPs to bond together? Like what's kind of the play here?
Yeah, so I think you could probably bifurcate the page between strategics and private equity backed strategics, and then everything to the right of it. And so on the left, it's like what you said, Steve. They're bringing them in, they're subsuming them some form or fashion, and each culture is different. Maybe when you subsume another MSP, it means that it's your own entity in this geography. Nothing changes except for now you have to use ConnectWise or something. They're going to have a defined roadmap though on what culture and integration looks like. Everything to the right, private equity, independent sponsors, searchers, it's really Wild Wild West. Like there's no defined playbook of XYZ if private equity comes into your company, what happens to the culture? It's much too general of a term or general of a concept to really have a definitive point of view. I would say Generally, though, you're partnering with the team, you're partnering with the individuals that have already created a successful organization. And so we're coming in as investors, evaluating your company, and we like it and we see it, and everything you've done is great. And we're looking to probably accelerate it. But day one, it's not a novel concept, but I would say almost everyone on this list, day one, they're going to say, don't break anything. Nothing changes. Because fundamentally, we're backing the company that's gotten to this point. And over time, I would say you'll see a probably injection into the culture around accountability and meritocracy. Is probably a somewhat of a defining characteristic as financial people get in there. And so more data-driven type decision making. But again, the rule of thumb, and it's not a novel rule, and I guaranteed most everyone would say it, is you don't want to break anything. You're partnering with the company because of what they've done already today. And there is how do you optimize and build around it.
Okay. Very good. Are there more slides?
There's no more slides. We got 6 slides.
All right. We did it.
Perfect.
Baxter, is there anything else that you feel we need to go over?
No, I thought this was great, Donza. Really appreciate you joining. Appreciate everybody joining. Next office hours is in 2 weeks.
Yeah.
With who?
The next office hours is on February 6th with Hannah Page, Workland.
Awesome. We'll see you. Appreciate the time and have a great rest of the day. Thank you, Donza.
Cool. Thanks, everyone. See ya.
Thanks, everyone. Take care.